Having 100% tax-free income sounds like an incredible place to be in retirement. Every dollar of income goes directly to you. This is a goal many retirees aspire to. But in this video today, I might surprise you by showing you that you actually shouldn't want a tax-free retirement. Let's start out by taking a look at what it would take to have a tax-free retirement. We'll first look at an over 65 couple that has combined Social Security benefits of around $60,000 in 2024. Now, as you can see from this tax graph, this couple doesn't have a ton of room to fill in with additional IRA or pension income before they start seeing taxes applied to their situation. They could afford to add about $20,000 worth of income. Any income they need above that, they would need to take completely from Roth assets to avoid taxes. So we see this couple would need to have a relatively small IRA balance to maintain a tax-free retirement consistently, because otherwise required minimum distributions would force this couple to take much more than $20,000 per year. But what if that retiree had no IRAs and just Roth and taxable account assets? Because capital gains are taxed differently, this couple would be able to show a bit more in the way of, let's say, qualified dividends or long-term capital gains. As much as $45,000 in this example. Again, any income over this, they would need to take completely from Roth for it to be tax-free. So if you are aiming for a tax-free retirement, it's extremely important to maintain a manageable taxable account as well as a manageable IRA balance. The main takeaway we see here is that retirees will need to have the majority of their wealth in those tax-free Roth accounts, or they need to primarily be comfortable living just on Social Security. And just as a quick note for those single retirees out there, the tax picture becomes a bit tighter if you aren't married. Because you have half as much room in each tax bracket as a single filer, you will have much less cushion before you start to see a growing tax liability, as shown on the screen here. Okay, so now after laying out the foundation for what it takes to be tax-free, I want to zoom out and ask, what is our primary goal with tax planning for retirement? If we could put everyone watching this video in a room and I ask, who in here would love to have a tax-free retirement? I'm sure just about every hand in the room would go up. Why? Well, first, a tax-free retirement just feels fantastic. Being able to withdraw exactly what you need without having to withdraw extra in order to pay taxes feels fantastic. Second, if you watch a lot of our videos here on our YouTube channel, you'll notice that the US tax system can be quite complex, especially for retirees. There are a lot of things to consider. Having a tax-free retirement is just simple. And so on the surface, all of us would agree that we would love a tax-free retirement. But the reality is we have to make decisions and pay taxes in order to get to this point. For instance, while you are working, you would have to make the conscious decision to pay taxes up front in order to contribute most of your wealth to Roth accounts. Or early on in retirement, you would have to perform Roth conversions to empty out those traditional IRAs and convert them into Roth IRAs. A tax-free retirement costs something at some point. So if we zoom out, the real goal of tax planning for retirement is that we want to make decisions that lead to us having the highest after-tax wealth. Maximum after-tax wealth is the chief aim here. And with this aim, we'll see that a tax-free retirement will never be the best option. Here in the US, we have a progressive tax system. This means that if you are showing more income, you are paying a higher tax rate. The tax system doesn't have as many holes in it as the media likes to make it seem. It's very difficult to get out of paying taxes. Retirement accounts, for instance, simply allow you to choose when you are paying taxes. If you want money in tax-free accounts, it means that you're paying taxes up front either on a Roth conversion or on a Roth contribution. Let's take a single individual who is making $100,000 while working. Now, right now, their top marginal tax bracket is 22%. So if they contribute to Roth IRAs, they're paying 22% in taxes on that contribution in order to get that into Roth and have that be tax-free on an ongoing basis. The opposite choice would be to contribute to traditional IRAs. They would get a tax deduction for doing this and would avoid 22% on the contribution, but then they would obviously owe taxes when they take that income out of that IRA in retirement. The point being, taxes are paid at some point. So why does this matter? Well, when we make the decision on whether a Roth conversion makes sense, or we are making decisions on whether we should contribute to Roth or traditional, the right decision comes down to the rate we are paying today versus the rate that we would be paying in the future. It all comes down to tax rates. I have a simple proof of this on the screen. The commutative property of multiplication states that the order of operations does not matter. For instance, if you have $1,000 and you pay a 15% tax rate up front, and then you grow that money for 20 years, you will have the exact same amount as if you took $1,000, grew it for 20 years, and then paid a 15% tax rate at the end. If the performance is the same in both scenarios, when you withdraw income and pay taxes, doesn't matter if you are paying the same rate. Now, I'm a massive fan of Roth conversions. Strategic Roth conversions can be an incredible tax saving strategy, but they only make sense if you are paying a lower tax rate today than you would otherwise see in the future. If you are paying a higher tax rate today to avoid a lower tax rate, then we will see that Roth conversion no longer makes sense and actually is subtractive in your after-tax wealth goal. So if we flip back to that progressive tax system slide with this in mind, we can see a rough map of where we want to pay taxes and where we would prefer to defer taxes. Again, it all comes down to the rates. So if you're in the accumulation phase and you're in a low earning year relative to your other earning years, you should prefer to contribute to and save into Roth accounts. If it makes sense to contribute to Roth, it will also likely make sense for you to do things like Roth conversions as well. On the flip side, if you have a very large earnings year, either because of a great year at work, or maybe you had a really large taxable event, you should prefer to avoid contributing to Roth, even if it's tax-free. Instead, you should prefer to contribute to tax-deferred accounts to earn a deduction today from those high rates. This would also rule out doing things like Roth conversions in this type of scenario as well. Typically, earnings grow through your working career. You may also be in a career with volatile earnings. Your tax preferences should adjust as your income and tax brackets adjust. And so if you've been making quality tax decisions up to this point, you should enter retirement with some mix between your tax-deferred accounts, your tax-free accounts, and probably even some money in taxable accounts as well. For someone who enters retirement with all Roth assets, they likely got there by making suboptimal tax decisions. For instance, if you paid a 22% tax rate to get money into your Roth, and now all of your money is in Roth, you made a mistake. Think about it. You paid 22% on the contribution. You could have avoided 22%, contributed to a tax-deferred account, and withdrawn some of that income at 0%, 10%, and 12% rates before ever seeing a 22% rate in retirement. Similarly, if you enter retirement with a mix between your various tax accounts, the only way to get to a tax-free retirement is Roth converting early in retirement so that the majority of your retirement assets are now tax-free. Remember, in order to have a tax-free retirement, we need mostly Roth assets, or we need to primarily live off our Social Security benefit. So let's walk through a case study to bring this all together. Here we have a couple with $55,000 in Social Security benefits and just under $1.5 million saved for retirement, $1.2 million of which is traditional IRA assets. Now we can see based on the tax graph on the screen that this couple will have some tax problems if they don't step in and do something about it. We project that their traditional IRAs will grow and keep growing to a point where required minimum distributions force them to take out more income than they need, thus forcing them into higher and higher brackets in this progressive tax system. This is a classic example where Roth conversions make a ton of sense. If we can help this couple avoid being taxed at higher rates by doing Roth conversions today at lower rates, there's going to be some substantial improvements in tax planning. But this is also where tax planning can go awry. Many books and YouTube videos will consistently bang the drum on how great it is to have a tax-free retirement. Because of this, many retirees mistakenly arrive at the conclusion that this is what they want for their retirement. So let's look at what it would take to get this retirement to that point. This couple sees their RMDs are the main problem here and just wants to be done with those RMDs before they ever are forced to take their first required minimum distribution. They also want a tax-free retirement for as long as possible. Because of this, they find that maxing out the 24% bracket allows them to completely convert all of their IRAs within 3 years. Then moving forward, they will never pay taxes again. But here's the problem. This would have been a bad decision. Think about it. In a progressive tax system, if we want to pay the lowest tax rates possible, then ideally we want to spread out income as evenly as possible to ensure we pay those lowest rates. We would actually find the optimal strategy is not a tax-free retirement in this situation, but rather paying taxes each and every year. Their optimal strategy would be to max out the 12% bracket with Roth conversions. As you can see, this does a fabulous job spreading out this tax liability. Now, this isn't as sexy as a tax-free retirement, but it will save you far more money. If you compare the after-tax benefit of each of these strategies at various points in retirement, we will see a significant gap in the differences between these two strategies. By the end of retirement, there's almost a $700,000 difference in value between these two strategies. One leads to big tax benefits, while the other actually leads to tax losses, where Roth conversions actually hurt their situation. A tax-free retirement might seem like an incredible place to be, but not when you consider the costs it takes to get there. If our goal is to have the highest after-tax wealth possible, then our goal should be to pay taxes, but pay it at the lowest rates we can possibly pay. Hopefully this video helped to dispel some common tax myths and misguided agendas. Aiming for a tax-free retirement is a mistake, but here are 5 other Roth conversion mistakes that I commonly see from retirees. Click here to learn more, and always remember, you don't need more money, you need a better plan. Thanks for watching, and we'll see you in the next video.